Good afternoon. This is Brandon, Tiffany, and Luke's Worldcom Case. The organizational chart of command pertaining to Cynthia Cooper is pretty similar to what most telecommunications companies most likely had within that time period. She was an internal audit director, and she had 24 people on her team. And her department directly reported the CFO, Scott Sullivan, who also directly reported to Bernie Evers, the CEO. She had two main senior managers and helped with the investigation of the fraud, whose names are Gene Morse and Glenn Smith. A timeline of events for Worldcom really starts back in '83 when they separated from AT&T and became Long Distance Discount Services, or LDDS. Bernie Evers was appointed CEO in the early days. He was described as many as a great leader and described himself as the only reason he got the job because he was the meanest SOB around. However, while he didn't have tons of experience in the field or as CEO, he was very good at what he did in the early days and grew the company very rapidly through mergers and acquisitions. The company went public in 1989 and in 1995 became known as Worldcom. By '98, they were the largest full-service telecommunications company in the U.S. However, in '99 and 2000, General Accounting began releasing accruals against line costs. And in 2001, Sullivan, CFO, capitalized expenditures related to unused line costs of the company. In 2002, Cynthia Cooper presented her audit findings to the Fraud Committee. And also, by later 2002, the company filed bankruptcy. The major players in Worldcom fraud were CEO Bernie Evers, Scott Sullivan, the CFO, David Myers, the controller, Buddy Yates, the director of general accounting, Betty Benson, a manager under Buddy Yates, Cynthia Cooper, the internal audit director, Gene Morse, who was a senior manager under Cynthia Cooper, and Arthur Anderson, the external auditors. Bernie Evers kind of set the tone as at the top with his high-pressure management style, always wanting to maintain the revenues and the expense-to-revenue ratio. And that's kind of how he ran things and expected the company to do the same. This flowed through to Scott Sullivan, who also placed very high pressures on those under him, and eventually is what led to the fraud committed by Sullivan, Myers, Yates, and Benson. While those are not the only ones involved, those are the main ones who carried it out. Benson, being a manager, knew this was wrong, but she was threatened to be fired and also was given an incentive to be promoted if she did these things. And as being the only breadwinner in her family, she had no choice but to go along with it. The earnings management fraudulent reporting are two unique things. Earnings management is using techniques to create financial reports that may paint an overly positive position of the company. However, they still maintain and stay within GAAP principles. Fraudulent reporting, however, deliberately misstates or omits accounting information that deceived investors. Misuse by the accounting principals in the general department for Worldcom is what caused their issues. The motivation behind the fraud is not as simple as many people think. While they were very high pressured to maintain their expense ratio, there's also factors behind the decisions they made. Not only was the company top down with an extremely pressure-filled corporate culture, they also had market incentives. Since many of the employees' retirement plans and also many of the executives' compensation is based on the stock price, they wanted that stock price to be as high as they could, and their goal was to be the number one or the highest stock price on the number one stock on Wall Street, not to have the highest market share. And then also greed. With all fraud comes greed, just from the stance of these people had a lifestyle they wanted to fund and maintain, and when the company started struggling, they had a harder time doing that legally, so they committed fraud. The pressures that the executives face are enormous. Not only are they pressured to keep the company sustainable and make sure it stays in business, but also they have investor expectations at Wall Street. With these expectations, the company is supposed to perform at a high level and maintain its stock price and also exceed its current price and continue to be higher prices. This expectation is not only placed by investors, but also by the board, who expects the company to be run at a very high level so they can continue being paid as well. And then compensation as well. The compensation is a big factor here, as we learned in the case that Mr. Evers had many other holdings besides just the CEO of Worldcom. The fraud triangle components are incentive and pressure, opportunity and attitude, and rationalization. The pressure began for Worldcom in 2000 when the company realized that it was going to fall well below the expectations for the second half of the year. The pressure was passed down from the company's CFO and controller to the mid-level accountants. The mid-level accountants were initially pressured by their superiors to dip into the reserve accounts and were later pressured to commit more serious accounting fraud by capitalizing billions of dollars of operating expenses. Ms. Vinson, one of the mid-level accountants, committed the accounting fraud, threatened to quit, but felt pressure to keep her health benefits and high-paying salary for her family. Worldcom even gave Ms. Vinson an incentive of promotion during the periods that the fraud was taking place. The opportunity was a lack of internal control components in place for Worldcom provides an opportunity for fraudulent entries, proven when Ms. Vinson was able to create and backdate false journal entries. The opportunity for the initial fraudulent activity of dipping into the reserve account to cover other expenses was possible because of the subjective judgment involved with the accounting for reserves. Worldcom had the opportunity to get away with the fraud for multiple years because of the audit testing difficulty involved with a technological telecommunications company, combined with the complex transactions used in the leasing of other companies' networks. Rationalization was the Worldcom CFO and controller were able to rationalize the decision to dip into the reserves, fund to the mid-level accountants by telling them that they were doing nothing illegal and that it was only a one-time thing. When the mid-level accountants were asked to make fraudulent entries and capitalize operating expenses, they rationalized their actions by continuously claiming that it was their last time. The CFO helped the mid-level accountants rationalize their actions by telling them he was merely trying to fix the company's financial problems. Prepaid capacity is a concept used to determine the capability of a company to project the payoff of future costs associated with business operations. Capacity in general is the ability to pay, support, or allocate resources to provide a certain service at a certain level of production. With Sullivan's new accounting methods related to line cost, Worldcom greatly overestimated its prepaid capacity with the mindset that lowering estimates for future periods would eventually be leveled out by increased revenues as things in the marketplace return to normal. In Cooper's book, Extraordinary Circumstances, she writes that line cost adjustment, saying it is a spider web of amounts, moving as many as 3 times and finally spread in a small dollar increments across a multitude of different assets, mostly telecom, fiber, and equipment. In conclusion, prepaid capacity isn't actually a legitimate phrase when projecting future expenses. The first fraud came with the releasing of accruals that were designed to report estimated future expenses related to line costs. Sullivan stated that with recent mergers, line cost accruals were largely overstated and needed to be released so that the actual estimations were consistent with the expected future payments. This, of course, was false, as he was just attempting to reduce line costs associated with operations and therefore maintain a consistent income figure. According to the SEC filings report, the accrual releases resulted in almost $2 billion misstatements over a 2-year period for strictly domestic activities. The second fraud came in the capitalization of line costs in order to spread expenses for long periods of time. The result in almost a $3.9 billion misstatement related to these expenses. Worldcom was able to get away with this not only because of deceit by controls, but also because the fraud provided a consistent bottom line to investors. In summary, the capitalization essentially overstated income by transferring costs to the balance sheet and overstated assets due to the capitalization of these expenses. The stakeholders affected by the fraud included shareholders, investors, customers, and finally employees. The overall market was truly affected by the WorldCom fraud, as the company at the time was the largest international telecommunications company in the U.S. To paint a picture of how devastating fraud was, the USA Today article reported that WorldCom's problems are all too familiar to stockholders, who have seen more than $180 billion in stock value erased since its peak at $62.58 a share in April of '99, and then Tuesday the stock closed at $2.48 a share. Over 30,000 employees lost their jobs. $35 billion in debt that was owed to investors resulted in shares totaling only $5.4 billion, and the overall market declined drastically in the following months. According to Joe Schuman, senior producer for NBC, a few people did win, but one group was clearly in the win column. The lawyers, accountants, and consultants who billed the company for reported $800 million in fees while it slotted for bankruptcy recognition. They got paid in cash. Also, the employees are the saddest part because many of them lost their full retirement and became worthless. And they will have to work to regain, and many of them won't ever truly be able to retire. You may ask why these lack of internal controls weren't detected earlier. Well, the main reason is the distant relations of WorldCom's organizational structure with both WorldCom's external auditor and the board of directors. First, WorldCom's departments were spread out across the country, and this made it difficult for the different departments to fully coordinate and realize what was occurring in each department. Second is high pressure of corporate culture. Employees didn't have a chance to question their superiors, but only did what they were told. Thus, when financial times were difficult, subordinate employees were ordered to maintain WorldCom's 42% expense to revenue ratio, and accounting managers were ordered to release accruals that were too high. The managers had incentives to do so in order to continue receiving high compensation and to avoid personal criticism or threats that were very commonplace with employees who did not obey orders. Third, Evers and Sullivan ran a compensation and bonuses beyond the company's approved salary rate, creating an incentive for employees to go along with the fraud even if they detected it. Finally, the board had little to no connection with WorldCom to even realize the fraudulent practices that were happening. The Internal Audit Committee, Cynthia Cooper and Gene Morris, worked as a team to dig into the company's scandal and finally blew the whistle to the board when they found out the original journal entry for virtually any expense. Morris, in order to get access to the company's financial systems, lied to the senior manager of IT of testing new software and stole the information out. Glenn Smith, the senior manager in internal audit, suggested to Cooper that do an internal audit of the capital expenditures immediately based on an email he received from one of the departments in another area. These people were able to do this because they had because of their ethics and weren't afraid of what could happen to them. Ms. Cooper's actions on the case were very important to future whistleblowers and also to those surrounding her in her immediate internal audit department. She was faced with pressures and intimidation by Scott Sullivan not only to delay the audit and was continually denied outright of information, but she kept digging and eventually her digging paid off. She tried to uphold the ethical integrity that she was taught through her professional organizations, and also ones that she knew was right. She had alternatives that she could have, such as to not do anything, continue just collect a salary, but she knew that this would definitely affect the stakeholders and also every party involved. She ultimately made the right decision to not help conceal the fraud, but to display it for everyone to see. Betty Vinton is both a victim and a villain in this case. She's a victim because she was under pressure not only from her superiors but also from financial pressures at home, as she was the lone breadwinner and also health insurance provider. However, she is a villain because she rationalized her commitment of the fraud and continued to do so even though she knew what was going on. Perhaps the external party most at fault is Arthur Andersen. While they knew that WorldCom was a very high risk because of other industry averages at the time seemed vastly lower than WorldCom's, they continued to operate at a normal relative risk factor when the maximum risk is actually how they should have operated. Their lack of prudence in this led to them not discovering the fraud or turning a blind eye to it, which led to the loss of billions by many people. That is the end of our slideshow. Thank you.